Hello and welcome to an FX Times daily video recap. I'm CMS Forex market analyst Nick Nassad. Today is Tuesday, December 15, 2009. We start today's broadcast with a look at the euro-dollar pair, which fell in favor of the greenback in overnight trading, extending gains the greenback has seen from Friday's session. We set up in a bit of a triangle formation in yesterday's trading. And we saw that in the European session, we broke out of that consolidation and fell sharply to find support at 1.4502 in New York afternoon trading. This is the lowest level that this pair has been since October 2nd, so more than 2 months ago. We see a pretty strong break below the 1.4680 level in this week's trading. That level had acted as support last week, but now has been retested as resistance, and we've seen a further slide below it. So today we even moved below the 1.46 area, which was our low from last week. Credit concerns continue to pressure the euro as we had a speech by the Greek Prime Minister, and his proposals to stem his country's fiscal troubles didn't seem to relieve investors. Worries were also amplified by the surprise nationalization Monday of Hypo Group by the Austrian government. So that's a multi-billion euro bailout, and it comes after even ECB President Jean-Claude Trichet personally intervened, urging swift action to prevent contagion through the country's entire banking system. So with sovereign debt fears surrounding Spain, Greece, and Dubai this past month, this bit of news helped to only accelerate the concerns surrounding the euro. In fundamental news from the Eurozone, Germany put out its ZEW economic sentiment for December, which declined to 50.4 from 51.1 in November, though that reading was slightly better than forecasts. The index, which measures the confidence of financial experts, showed that they expect a slow economic recovery, though while they have optimism in terms of rising exports, the downside is how strong investment will be. Investment could contribute to economic growth in 2010, but it depends on bank lending, and with banks still facing a difficult task to clean up their balance sheets, how much they will lend is still up in the air. The sentiment for the entire Eurozone slid a sharper 2.8 points to 48. The dollar-yen pair, we saw the greenback rising in today's trading, reaching a high just below the 90 level. We moved above the high we saw on Friday, and following our test of support around the 88.50 level, the pair has found a buying pressure again. The reason here is that bond yields in the US shifted higher, and the yield play is a big driver in the dollar-yen pair, as we have reported how the cost to borrow in yen compared to dollars was about to flip, putting the yen back as the primary funding currency for carry trade. Greenback strength extended to many pairs, and here looking at the dollar-Swiss franc pair, we see that we rose to the 1.0427 level, which is the second time in 3 sessions that we've rallied higher. We broke out of this range here in the middle of last week, and following our rise on Friday, we had another bit of consolidation, and we broke out of that in today's trading. If we zoom this pair out, we see that in the last 2 weeks we've had a pretty strong rally in favor of the greenback, breaking us out of our ranging conditions that we had seen throughout most of November, and our high today goes back all the way to October 2nd. So we'll see if the 1.045 area, which was our high here in late September, acts as resistance following our test of that area. In the UK, consumer prices in annual terms for November rose to 1.9%, which was a higher reading than expected by economists. The previous reading was 1.5% in October. On the month, inflation was of 0.3%, while core annual rate inched up to 1.9%. Looking at the pound-dollar pair, we still remain within this consolidation wedge pattern, and following our test of the 1.6320 area in overnight trading, we slid on greenback strength down to test support at 1.62. The pair found some support here, and like I mentioned, we remain within this range between 1.62 and 1.6350. However, this is a pretty nice contrast to the euro-dollar pair, which saw a sharp break of its support levels in the last several sessions. If we look at the euro-pound pair, we see that we fell below an important support here at 0.8980, and we reached about a 4-week low at the 89.20 level. We have been setting up in a bit of a descending triangle pattern. So you could also make the case that it was a bit of a downward channel. Regardless, the pair is definitely favoring the pound following the start of December, and we're now looking at our lows from around 88.50 as a point of strong support, though we have some earlier support levels around the 89 level here. Turning to U.S. fundamentals, we had 3 reports today. Let's start with producer prices, which surged 1.8% in the month of November, a figure that was nearly twice expectations. The main reason for the jump in wholesale prices was a 6.9% increase in energy costs in November, following a 1.6% gain. Excluding food and energy prices, prices increased 0.5%. The increase in the core rate was still the largest since October 2008, and the overall headline rate is the highest in a year as well. On the year, producer prices were up 2.4%, the first positive annual reading since last November. So there's a bit of a whiff of inflation in the air, and we'll see in tomorrow's consumer prices if that is confirmed on the consumer side. The second report we will look at is industrial production data for the month of November, where we saw output rise by 0.8%, a figure that was slightly better than forecasts, while the capacity utilization rate, which is the measure of factories currently in use, rose to 71.3%. The increase was rather broad-based as we saw manufacturing production rise by 1.1%, with cars and output up 1.8%. Excluding autos, production in all other industries was still up 1.1% as well. The report implies that companies might be rebuilding their inventories following a rapid liquidation of stockpiles during the recession. However, we had a third release, the Empire Manufacturing Index, which may dampen some of the expectations regarding the manufacturing sector for the December period. In that report, the Empire Manufacturing Index for December showed a sharp deterioration down to 2.5, which was sharply lower than forecasts and the reading we had in November. New orders slid to 2.2 from 16.6 last month. The index for shipments fell to 6.3 from 12.9, and the employment index declined into negative territory at negative 5.2 from 1.3 in November. Though it's just a regional manufacturing survey, it could imply that manufacturing would not give the economy as big a thrust as first imagined. We'll see what our other regional manufacturing surveys say the rest of the week. And we did have a rather positive October output report, so we'll see if this perhaps may be an outlier. Now let's turn our attention to some upcoming releases. Tonight, Australia posts its leading index and then its figures for third quarter GDP growth, while Japan posts its tertiary industry activity index. Overnight, Germany and the Eurozone passed their flash versions of their services and manufacturing PMIs. The UK posts its claimant count, its measure of monthly employment, and the Eurozone will release its final version of consumer prices. Tomorrow, the US posts its consumer prices, measure of housing starts and building permits, its current account, and the Federal Open Market Committee will conclude its interest rate meeting and put out its statement. Also tomorrow, we will get Canadian manufacturing sales. The Fed is not expected to make any big policy shifts in tomorrow's conclusion of tomorrow's meeting, but traders and investors are at least looking for some kind of recognition that the outlook for the economy has improved with the recent data we've been having. And that will wrap up today's fundamental recap of the Forex markets. I'm CMS Forex market analyst Nick Nassad. For more videos, news, and analysis, please visit our site fxtimes.com. I want to thank you for watching and happy trading.